Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about some good news for housing from the jobs report and whether we've finally seen the top for mortgage rates. Logan, welcome back to the podcast.
Happy Jobs Friday. And the only thing I have to say right now is land the bleeping plane, Jay. Land the plane. Come on, McFly. What's the data been telling us for so long? It's not the 1970s. You baby boomers have to give this up. Okay, so we're talking about Jobs Friday. It's Friday morning right now. And I think the last time I saw the 10-year yield was 4.51%. So it's a very wild, extreme week on the bond market side. And again, one of the things we've tried to emphasize, when the market really believes that the Fed is done hiking rates, the history of this is that mortgage rates go lower, bond yields rally, meaning yields go down. So there was no need. It was so unnecessary for the Fed 2 meetings ago to go hawkish. There was no point in it, right? There's nothing. It's so frustrating. Oh my God, it's so we wasted like 6 to 7 weeks for no reason out here. And hopefully we can start the process of talking about landing the plane and stop this 1970s wages are spiraling out of control. We have to destroy it. No. It's not. It never was. It was a global pandemic. That's what all the data looks like. Wage growth has been slowing down since January of 2022, and just land the plane. So hopefully this is it. That was it. That was the peak in rates, and we follow the history of economics, and the Fed becomes a little bit more friendly in the sense of talking less hawkish. That's what we want, less hawkish. And God, if another Fed member comes out and goes, oh, we need another rate hike, we need to know, just shut up. Just shut up. Come on. Okay, so the jobs report wasn't terrible in the sense that if you adjust to the people that are on strike, but it's just showing that the labor market is balancing back up. And that's what the Fed wanted. So there's no need to push it at this stage. After all the rate hikes, after everything, there's no need to create a job loss recession. It's over. You're going to lose your credibility from everyone that's been trying to say this. If we were in the 1970s inflationary mode, inflation would be going up, Jay. Wage growth would be going up, not slowing down like it has, with a tighter labor market, with the economy growing, with job openings, near 10 million. Okay. Adapt, adjust, be nimble. Okay. So that's my morning rant.
We appreciate that rant. So, we have had an entire week of data, and you just sort of recap some of that with the job openings and all that. But for you, it's been key to where mortgage rates are going, because where bond markets are going has always been tied to labor, to the labor market and what's going on with jobs. And also, it has an inflation story to tell, but kind of break down why you think this jobs report should be the nail in the coffin for higher rates.
Well, it's a trend. It isn't just one report. Nobody should look at one report and talk about, okay, we need to make an entire monetary policy. So let me give everyone an example here. I track economic cycles first. Housing is a secondary. So let's go back to the COVID-19 recovery model. COVID-19 recovery model, April 7th, 2020. We are recovering this year, folks. There's going to be no depression, okay? The labor market structures are different here. Demographics are different. We have the baby boomers leaving the workforce, right? Household balance sheets are better now. 30-year fixed mortgage, right? Everything's good on that front. Once behavior changed, it goes back. Now, the second phase after we retire the COVID-19 recovery model on December 9th, 2020 is the labor market. And the keys were, we're going to get all the jobs back by September of 2022. Guess what? We got all the jobs back by September of 2022, right? And then the third is that we had a missed jobs report. I think it was in May of 2021. And people were like, oh my God, we're paying people not to work. No, we had the biggest job numbers with $600 weekly unemployment insurance. Okay. The data is going to work itself out, but we're going to get the job openings 10 million. So I tripled down on that. I think job openings were under 7 million. We got up to as high as 12 million. But if you look at it in this aggregate, If there was no COVID-19, with the labor force growth, immigration, population growth, everything, we should be between 157 million to 159 million total employment. And we are going to go in that direction. So naturally, the job data are going to slow down. So this notion of, these higher, stronger job prints, that are they inflationary? No, they're part of a global pandemic recovery, right? There's some disjointed in the entire economic equilibrium. So it has to work itself out, but it's going to naturally slow down. You don't have to worry about this. So here we are, Sarah. We're in November of 2023. Guess where we are in total employment? We're about 156,932,000. We're so close to being just back to normal. And that's the key, right? And then when we're normal, wage growth is going to slow down. Things are going to be back to normal. There's no 1970s entrenched inflation. If that was the case, wage growth would be rising. The growth rate of inflation would be rising. They're slowing down together. So you don't have to crash the plane. And I hope everyone in the country, I hope every report just bombards the Fed on this. Change your course. Land the plane. Okay, so what we've done with the labor side of this economic cycle post-COVID, everything kind of looks right in that context. So there's a lot of noise in this report. We had negative revisions, but it just looks like the same trend. It looks perfectly normal to me. When you make some COVID-19 adjustments, everything looks normal. There is no runaway inflation, runaway wages, runaway like that. So you don't need to overdo it. That was the frustration part of the Fed meeting two meetings ago, when they were really hawkish after all the rate hikes, after the 10-year yield was above 4%. The 10-year yield really should not have gone above 4.25%. And then bond traders went crazy. And now there's a lot of people that were short the bond market, so their trades are getting killed. So naturally, we're getting very overbought conditions. This week is crazy. We went from like 4.94% to 4.50% in a very short amount of time. Not normal activity. But when you get into stages of tops or bottoms, you get a lot of volatility. And that's why I say it looks like to me, and we've been talking about this for something, it looks like the kind of the top end of the market because of the volatility and how wild. And God, I'm staying up like till 12 and 1 o'clock in the morning looking at overnight 10-year tradings. God, I just want over with that. And just land the plane and let's just get back to normal, and we don't need to overdo it.
Okay, so you know what my question is going to be always. What does this mean for mortgage rates? What are we looking
mortgage
at?
rates are lower. We're not that far from 7%. The pricing gets normal and the spreads are getting better. We're closer to 7% now than we are at 8%. So, and we've talked about this. How does mortgage rates get to 8%? Well, the economy has to be very firm. GDP was good, but the labor market, jobless claims are still low. And then the Fed mistake. They messed up two meetings ago. They didn't need to be as hawkish. So hopefully now we'll forgive them. But this means going out in the forward, you can't do this hawkish stuff. And for somebody, do not let Neil Kashkari come on TV again and go, oh my God, mortgage rates at 7%. People might buy homes. Just go away, leave. Okay. Let the economy work itself out. You don't need to do anything aggressive now. You've already done, take the victory and let it go. Right. So this isn't a pivot discussion. But the unemployment rate has jumped up 0.5% from the lows. If you take the Claudia Shaw rule, which Claudia Shaw used to be the economist for the Federal Reserve, as a friend of mine, she made a model where the recession is basically here when the unemployment rate goes up 0.5%. For me, it's economic cycles really just move around jobless claims data at this stage, but there's no need to push it because not only have we got the unemployment rate up, not only is wage growth slow down, productivity. Oh my God, the productivity numbers were good. That was a welcome sight. And I can't stress enough how important it was to have that productivity growth, because the Fed is like, hey, listen, if we get productivity growth back, that in itself could be a reason to cut rates, especially with a 10-year yield as high as it was next year if the growth rate of inflation falls down. So just land the plane. This week was good in that sense that for the productivity numbers to me were the best number. Job growth looks normal to me. Jobless claims rose up a little bit. Continuing claims, I know a lot of people see the continuing claims accelerating higher. Just remember, continuing claims has a seasonal quirk in it. It does this seasonal increase toward the second half of the year, and then it tops out and goes lower. You want to look at a headline jobless claim. Jobless claims data is still very low historically, but again, all this is happening with the growth rate of inflation falling and wage growth falling. That was not the 1970s. So let's move on. Let's get rates lower. Let's get the economy going and land the plane. There's no reason anymore. Land the plane.
Okay, land the plane, but do you think that means rate cuts this year? No, right? I mean,
No, no. I
you don't
mean,
see them doing
no,
anything.
no. There's no rate cut discussion. Um, I'm not a Fed pivot person because I truly believe the Fed is naturally old and slow, and they just don't operate that way unless you have a noticeable decline in activity. We are we're in the stage where we're like flashing, you know, airplane signs. Hello, hello, come here, land here, land here. So you don't need rate cuts for mortgage rates to go down, um, but you need the 10-year yield. So as we've always talked about, Sarah, that slow dance since 1971. 1971, 10-year yield goes up, mortgage rates go up. 10-year yield goes down, mortgage rates go down. That those love couple dance partners there. They have never strayed from us. Now the spreads are wide historically now, but if you get lower spreads, the 10-year yield going, you're easily going to get under 7% mortgage rates again. There was no need for mortgage rates to get to 8%. The economy was not, accelerating on inflation data getting out of control. So no rate cuts, no Fed pivot. We just want them to land the plane, and the housing market revolves around the 10-year yield and what that goes upon. And it was a good week in the sense that wage growth is cooling and productivity is up. I can't stress to you how good it is, the productivity data going up. And that's a positive direction from people saying, oh, that, the Fed has to hike another percent. The 10-year yield has to go to 6. No, we don't. Real yields were already restrictive when we were under 4.25. It just got very restrictive after. So we want the economy to expand. We don't want to talk about needing a job loss recession. We don't need to have pain. We need to evolve ourselves from this mindset of economic cycles about creating recessions because it needs to cleanse. No, we can move this forward. It's a global pandemic. It happened. We've seen this before. There's an inflationary period and then there's a disinflationary period. No rate cuts. There's no Fed pivot coming, but at least the bond market is, like we talked last time, getting ahead, right? And it still has a lot more work to get ahead of the Fed, but very, very wild week, very intense. I mean, very intense last few weeks out here. And hopefully things start to calm down because I could tell you this. One of the things I talked about on social media, it's not a healthy thing when mortgage rates move 0.5% in days. To go from 7.5% to 8%, then 2 days later from 8% down to 7.5%. I understand the how when you have violent moves in rates, just being in contract, right? There are people out there that when rates went from 7.5% to 8%, they can't qualify. They have to get out of contract. Then 3 days later, it's below 7.5%. It's like that. That's why it's not a healthy thing. That's what, we used to talk about this. The mortgage rates in America look like a third world country. Last year, we went from 3 to 6, 6 to 5, 5 to 7.5. It's just that. It's the United States of America. We should not be that unstable with mortgage rates. So a calmness, some nice slow dance music and things to settle down and in this front, and we'll take it from there. Of course, the labor market is not breaking. There's nothing going on there on that side, but you don't have to force a job loss recession, which has been number one for us here for some time. The growth rate of inflation will fall. This is the history of global pandemics going all the way down to Amsterdam back in 1600s, stuff like that. We know this. We've seen this before.
Yeah. So let me ask you. So this time last year, what we saw was falling rates just for a little bit, and that that meant that people jumped back in the market. We had purchase apps go up, which meant, we had sales in the first quarter, and you sort of identified a range there of like 5.99% was going to be like, once it got to that, we would see this jump. Do you have a range right now where you're like, hey, if we
So
get to X, we might see that?
So here's the thing. The purchase application data is so low. We're back to 1995 levels. By the way, TLC Waterfalls was one of the top songs back then. So in any case, that's what we're dealing with. Because we have such a low bar, it doesn't take much to move the needle. Now, what happened is, guess what? What happened last year, November 9th? Remember November 9th, we talked about, okay, the sales are going to get down to 4 million. Guess what? We're already at 4 million. So can we have a repeat? Yes, we can, but we need to see how the forward-looking data is, because now we're going to have some data that's working with higher rates. Then we have to track the weekly. See, this is why the weekly tracker is key, because things can change very fast, both up or down on rates, and it can change the data. So if we get continuation here, right, we can have somewhat of a repeat last year. Now, last year was different because we went from 7.375 down to 5.99. We had 3 months of lower rates. Duration took us down to, that Gandalf line that we bounced off from. So we're far from that. But like I said, when you're working from a very low bar in sales, it doesn't take much to move the needle. That's the whole thing with the new home sales sector. Like, new home sales sectors was so low, people thought, well, we have to get down to 250, 300,000 new home sales, and the forward-looking new home sales data started to get better. So we'll be able to track this. This is why it's very key. Whenever the 10-year yield makes a reversal or a big moves, we follow the tracker, we follow forward-looking data, and then we take it from there. God, this is going to be so exciting for 2024, because this is supposed to be my last year next year. 2024 was it. There was no plan to do anything after that, and we have somewhat of a similar backdrop, but we need a 10-year yield to go much lower for this to work, and we need the 10-year yield to go lower and stay lower with duration. Duration is always key with data, but what a crazy week! What a crazy week this has been. In a crazy period of time, there's nothing normal. And just to put this into the magic hat of all the crazy weeks and days we've had post COVID. But again, it's not the healthiest thing when rates can even move almost 75 basis points to 1% lower, when people are in contract and like, oh my God, I got locked at 8% and now it's 7.37. It's just, that's why it's not a healthy thing, both up or down.
So, hang on. I totally lost my train of thought, but I had a really good question. Hang on. Okay, got it. It's interesting to look at this time last year and think that 5.99 was a thing. And then now we're super excited about, if it's in the low sevens, that could spur more people to jump in the market. Like, it's so crazy where we are this year versus last year. And also just like the psychological part about rates. If you've been seeing 888 and it goes down into the low sevens, that might be, you might think, this is the best I'm going to get. I need to jump in. If you're someone who's already needed to buy.
Here's the thing, Sarah. I'm not a fan of the sideline home buyer.
I know you're not.
I'm
I
not.
know.
I'm not a fan. I just think there's natural demand curves in housing economic data that has been very simple to read, and what we have always seen after 2010. Because remember, after 2010, qualified mortgage laws are in place. Whenever rates rise, and it's rise with duration, demand falls. Whenever rates falls with duration, demand picks up. Because of the equilibrium of the supply and demand imbalances of a housing market, if you're working from a lower level, that marginal home buyer that was waiting for rates to fall, picks it up. But we still have this massive core buyer every single year, that 4 million level that I've always talked
Right.
about. That's always there. So we're working off the edges. So the edges actually can increase in demand because we're working from a lower level, or, working from a higher level. Guess what? Sales could fall. So it's early in this process, but just like last year, last year remember last year we were trying to convince people that, hey, listen, the forward-looking data is getting better. Housing isn't crashing anymore. And I was like, no, you're a shill. Home prices are going to fall 10, 50%. I write charts from 1929 and all this stuff. Listen, everyone, 99% of the stuff out there is garbage. It's always been garbage. And you don't listen to stock traders, okay? You do not, out of all the groups and people, you don't listen to stock traders. Stock traders don't track housing data. Stock traders take technical levels on charts and they just make up something. This is not the case. We have forward-looking housing data that actually matters because purchase application, somebody actually has to file a purchase application data, right? There's an affordability index, right? They buy a home through a process. That process looks out 30 to 90 days. That's how it's always worked. So we will need to track this more carefully now that rates have fallen, but we need more follow through because if you can get rates to 6% again, stabilization in the data is there, but it actually showed us we could actually grow from these levels. If we were working from like 5.3 million existing home sales, that's not going to be the case. You still have room to go down, except we had the biggest home sale crash. This is why I've always tried to emphasize first. We literally had the biggest home sale crash in history last year. And, those buyers are still there, right? So you're looking at a 2.5 million spread of buyers that were in the system. That was with much lower mortgage rates. However, the equilibrium of that group, if you get to 6%, what do we see? We saw one of the biggest month-to-month sales prints ever recorded in history, with rates just getting to 6% because that spread, that buyer right there is there. They're just waiting for lower rates and lower rates with duration, time, right? So people can make choices, right? You have your leases. You have to realize, do I need to do my lease again for another year? Or, I'm selling my home. I feel much comfortable if rates are at 6.25% than 8%. I can't qualify at 8%, but I can qualify at 7.25%. So there's all these things going in play. And this is why tracking forward-looking data, the history of U.S. economics for housing, if you track forward-looking data, it does work just because, housing looks out. It's a process. It's not like a stock that you sell or buy within 2 seconds. You have to fill out an application. You have to look for a house. You have to place it on. There are all these things. It's not a very liquid marketplace. So stay away from stock traders. Follow actual data. We'll be here. This is why we created the tracker, so everyone could actually see this. And if it does have material changes, we'll see it in the forward-looking data. But first things first, you can't grow the housing market unless the 10-year yield falls with duration.
Right. So I just want to point out that what you just described was sideline homebuyers. I mean, it literally, that was no.
The sideline
Let me say.
home buyer.
So there are people who are waiting, and when it gets to a certain percent, they're going to jump in.
I know, but the people say the sideline home buyer, they come to the market when rates are going up.
Okay,
that's the problem I have with the sideline home buyer.
Okay,
If you
so
go,
the way I'm using
literally Google sideline home buyers, and you can see these TV media people go, "Oh, mortgage rates ran up because the sideline home buyer rushed to the market to change." No, that's not how it works. There's this whole process of home buying. Okay, so naturally somebody actually had already thought about buying a house. They can't buy right now because rates are too high or they wanted. Okay, it's the process. But the sideline home buyer was actually something where, rates went up. So purchase application data went up this week because of sideline home buyers.
Okay, well, what I'm talking about is exactly what you just described, which is there are people ready to buy. A lot of your demographic work looked at these at 2020 to 2024 and said, we have this huge demographic patch of people hitting peak home buying age. And those people have been sidelined. Well, I can use a different word if that one triggers you.
If you want to, I mean, I'm not a fan of the pent up demand, but you could actually see, because rates went up so much so fast that the sales have decreased so much that there's a spread of buyers out there waiting for rates. That's perfectly normal.
Okay, so I will use pent up demand from now on so that you don't.
No, you can listen, Sarah. You could use sideline home buyer. You could use mortgage rate lockdown. You could. I encourage you to use the words you need to
I
do.
can be right.
I've done this so long that when I think of sideline home buyer, I think of people on TV saying, "Oh, well, mortgage rates ran up 0.25%. People rush to go buy their house." I don't know. That's not how it works, or, rates fell down, people rush to, no, I mean, you'd have to see these big moves. I mean, it's just we want to keep it simple. Rates go down, demand picks up, rates go up, demand goes down, right? We don't have to give these marketing terms to it, but we're now, hopefully this continues in terms of the 10-year yields getting that. And once we can get below 4.25 again, where it should have always been, then we can start talking about things. And And just remember, the bond market was extremely short. It was extremely oversold. And when it reversed courses, there are a lot of people who are losing money, and they're just covering their shorts, and it could push the 10-year yield much faster and stronger. And again, this is traditionally happens at key technical levels, or market tops or bottoms. So we'll see. We still have so much work to do on this to get rates lower, but at least for this week, it was positive. And again, for those of you that follow my Instagram stories, we try to teach like the technicals of the 10-year yield. And we had a high, we had a lower high, we had another lower high, and then it snapped. We broke that under 4.87, or got under 4.6, we were snapped. So there's a process to this. And just this week, I think markets were so oversold on bonds, so shorted, that the moves are being exaggerated by that.
Okay, in the last few minutes that we have, I want to talk about inventory, because it's Friday, which means you get your Altos data tonight, which you love, and so you're going to be able to look at what the inventory is. We're in November now. We've had all these things. What do you expect inventory to do?
We're at the seasonality time of inventory, so it's not like it's a place where inventory will explode higher. So we're going to see, when does the seasonal decline start. Now, higher rates have created more inventory. Inventory growth has picked up more later on in the year. In a normal time, we would have inventory declining right now. But the mortgage rate lockdown is not working again. Higher rates are creating more inventory. So I'm shocked. It happened once again. I don't understand. I was told, so in any case, the growth rate of inventory has just been slow. And I'm just going to tell you guys this. There's so many people on the internet trying to like make a story. Oh my God, new listings data is up 100. Things are changing. No, there's not. You've got to be careful of people on the internet. New listings data is still trending at the lowest levels ever. Okay. It doesn't, nothing happens until you get that growth in the spring and summer months. So the growth rate of inventory we want to see, because higher rates, weakness in demand, days on markets, growing should continue that. But we're in November, so usually we see a seasonal decline. The question is, do we even get to flat to year over year growth? I mean, that's how much the inventory has been growing with higher rates the last few weeks, that we're actually talking about we could be flat to higher now because of higher rates, and the mortgage rate lockdown didn't work again, and the growth rate of inventory is picking up just like it has always. It's nothing shocking, just because the days on market take longer to sell. So, but again, the slope is very slow. We'll see if we could even get to flat to positive this year, which I think you can have that occur. But then we counter this. Okay, what happens with lower mortgage rates, and how does it go with that? So I'm waiting to see if I even bat. I'm running out of time to even have one inventory growth level hit my target level of 11 to 17,000 on the weekly data. We haven't been there. And it's just that it's November now. So the seasonality really kicks in. If this was spring 2024, we probably would have already seen that. But seasonality is such a big factor at this stage. We just want to see, when does that seasonality really start to kick in.
Well, we're going to end this podcast on a positive note, because here we have a good jobs report that shows exactly what we thought was happening, which will hopefully slow the Fed down and convince them. But even more than that, the bond market has reacted. And so mortgage rates going down, that's such a positive.
Yes, and the labor market isn't breaking; it's just slowing back to normal. And this is why we always talk about in those labor articles that I write, that once we get into that 157 to 159 million, we're back to normal, and we shouldn't have these really big job numbers just because of population growth. And the fact that productivity is growing again, I can't stress it. That the best thing I saw this week was the productivity data, and that's such a key. That is the most blessing thing. I got Christmas present early by seeing that. If we could continue that, then we're going to start to see the Fed, if the growth rate of inflation slows down even more, talk about rate cuts to just start making sure that the expansion continues. Because remember, nothing is positive of a job loss recession. There's crazy people out there that have said, yeah, no, we need millions of people to. No, you don't need millions of people. Supply chains get better, supply grows, you find that equilibrium, that balance. So this was a good week in the sense where we're talking about productivity going up, job growth slowing back to normal. We should get that. Strikes messed up some of the data. We just get back to normal and we could calm things down and stop fighting a war. We don't need to fight the 1970s. It's not here, right? So positive things on that front. So definitely considering that the 10-year yield was recently above 5%, and now lower. Any good news on that front is a positive, because for me it's always the housing market revolves around the 10-year yield, and the 10-year yield a lot of times the economic data really pushes that.
I'll remind our listeners that Logan is giving updates on our Mortgage Rate Center page every day about 9 o'clock Central, 7 o'clock your time, something like that. AM. You're giving an update just on what the market's done.
Yeah, every morning around 7 o'clock Pacific times, we just go over. Actually, 7 to 7:15, we want to take the latest economic data and see how the 10-year yield revolves around that, and then give YouTube updates every morning on the page, and then we just work it from there. And again, a lot of the economic data is between 5:30 to 7, so we just want to see the market reaction. And if things get crazy up and down after that, that we just go with what happens in the morning, and then at least this way people have somewhat of an idea and have a place to go to see what the market reaction is to the economic reports of that day.
Logan, thank you so much for doing that and for being on this podcast. Good news at last, and we will talk to you soon.
Have a wonderful weekend, Sarah.
You too.